Micron stock, ticker symbol MU, reported earnings after the bell, and the stock ripped and then dipped to finish pretty much flat on the day. A slightly higher year in the after hours, but net we were really flat on the day for Micron. So we're going to talk about why that is the case. Why did Micron rip? Why did they dip? And is it a buy right now? But before we do that, if you could please go ahead, like and subscribe. It really helps me out. So let's actually talk about what Micron does. They are a global leader in the memory and storage solution space, producing DRAM, NAND flash memory, and SSDs and SSD storage solutions. They power devices like computers, phones, cars, and their products are crucial for AI, data centers, and various other applications. Now, guys, what their products actually look like is they pretty much manufacture these in various capacities. And long story short, on a motherboard, right, when you actually build a computer or data center, there's three key components. There is the CPU, there's the GPU, and then there's the memory. Micron creates these memory chips that go on the memory board. For every GPU or CPU on a motherboard, generally speaking, there's probably anywhere to as much as 8 memory storage devices. These go anywhere from 8 to 256 gigabytes, and they're flash storage, they're random access memory. It's fast, high bandwidth memory that you can access on the go, and it really does help speed along processes that sit in the background. Now, when we actually look at their earnings, you can see why the stock was actually up initially. Revenue grew 36%, EPS grew above 700%, absolutely insane, beating the analyst expectations by a wide margin. I mean, look at this, 161 versus 191 reported earnings per share. Big beats across the board, and we saw margins expand in a very big way. Gross margins expanded, net income margins expanded, free cash flow margins expanded, and net dollar figures also increased, as you can see, from about the 300 million mark to 1.68 and 1.88 billion dollars for this quarter. Very good stuff. The balance sheet is in pristine condition, $10 billion of cash, $16 billion of debt for a company that's expected to do about $10.7 billion in revenue in the next quarter. That was the guide, plus or minus 300 million. Gross margin set to expand as well. This all beat the analyst expectations. Very good stuff here. Operating expenses are set to remain flat at $1.2 billion, and diluted earnings per share to come in at about $2.50. So the company double beat and actually had a slight raise on their guidance. But now we have to ask the question, why did the stock actually dip? Because we know why it ripped. It had to do with, the double beat and a raise. Why did it pull back? Well, it had to do with the earnings call. The CEO and CFO came on. They started talking about China and some of the uncertainty they're seeing in China, and I guess the market didn't like that. Other than that, there was nothing to fault from this quarter. Great beat, great guidance. It was just a solid earnings report through and through. And we also got some market outlook commentary here from the management team. And pretty much they come out and say that there may be some tariff related pull-ins from certain customers. Again, the China uncertainty. But the biggest thing here is that the customers continue to signal a constructive demand environment for the remainder of the calendar year. Micron remain agile to adjust any unforeseen demand changes and may occur due to macro conditions or the evolving tariff related situation. We expect CY25 industry DRAM bit demand growth to be in the high teens percentage range and industry NAND bit demand growth to be in the low double-digit percentage range. We expect Micron's bit supply growth to be below industry's bit demand growth for non-HBM DRAM and NAD systems. So pretty much they are going to grow slightly slower than the industry. They are losing market share, but this is not new. This is something the market knows, and it's more than priced into the valuation of the stock. It's part of the reason why the valuation of Micron looks very attractive. Now, looking at the earnings in a more granular fashion, revenue growth grew 36%, but the cost of goods sold increased only about 11%, right? And that resulted in gross margin dollars increasing by 91% from $1.8 to $3.5 billion from the same quarter last year. Operating expenses only increased 20%, and that is why we actually saw net income attributable to shareholders increase 467%. And with share buybacks, that is how you get earnings per share growth of 700% plus. Very stellar earnings, a ton of operating leverage, the top line growing, exceptional earnings here from Micron. Diving into their revenue by category a little bit deeper, you can see here that the biggest categories now are officially, the compute and network BU revenue, which is AI data center, and then storage revenue, which again is also part of the AI trade. It's storage for data center systems. Now, these are growing significantly, and you could see it just back then, this used to only make up about, I would say, close to a quarter, maybe a third of total revenue in November 2023. That's compute and BU revenue. That now makes up almost half of the trailing 12-month revenue. And if you include storage solutions, that probably makes up 75%, maybe 70% of total revenue. Whereas in 2023, November 2023, these two segments equated for about half. So these two segments are gaining, I guess, share on the revenue totals, but we are still seeing growth in mobile and embedded, but they're growing much slower, more in the single-digit clip. And this purple stuff here includes DRAM and AMD systems, and the others include like SSDs and that type of stuff. You can see here that the revenue has been very, very cyclical, but officially hit an all-time high versus what they did here in June 2022. Very, very solid stuff. Now, where does this leave us with the valuation of the company? And you know what? It's actually kind of insane to see how cheap this company trades on a next 12-month revenue basis. I mean, just a couple of months ago at the tariff lows, you could have bought this company at 8 times forward earnings, 4 times EV to EBITDA. The valuation has probably since doubled at that time. However, still very cheap. EV to EBITDA at 7.5 times, a PE ratio of 14 times, right when the industry, stuff like Nvidia, AMD, the semiconductor industry as a whole, trade at an EV to EBITDA of closer to 17 and a PE ratio closer to 28 times. So really goes to show the discount that you do get from this company. And that largely has to do, again, with the cyclicality of their revenues, the cyclicality of their free cash flows, as well as the fact that they are losing market share. And that is why you do see a bit of a discount here. But that being said, when we look at our valuation framework, that discount lends itself to be a very attractive buying opportunity. I mean, when you plug in the trailing 12-month revenue figures, right, and you assume growth in 2029 of 14%, that is what management are guiding for, and that's what the street expects. By 2029, you're looking at $65 billion in revenue on 46% EBITDA margins. I think there's actually upside to this figure. I think you could probably see 55% at the top end if they really do continue to control expenses. And they have had quarters where they have had 50% plus in EBITDA margins, but we're leaving at 46%, which is slightly below what the EBITDA margin for this quarter was. I think it was 46.3 to be exact. So you're assuming $29 billion in EBITDA, using a 12 times EV to EBITDA multiple. So you're looking at slight expansion on this number. You get the enterprise value, subtract the net debt, divide by shares outstanding, and you get a share price of $321.80 in 2029. Current stock price is $127, and that looks for a 20% compounded annual growth rate with a 0.36% dividend over the next 5 years. Very, very solid. And if you discount the 2029 price at 15%, you get a fair value of about $160 per share. So the company trading well below their fair value. I think Micron might actually be a buy right now. I might go ahead and actually add some to my portfolio. These are stunning earnings, and I think the stock is going to probably move higher on the back of these earnings. But part of the reason why the stock did fall was because, the stock is actually up 50% year to date. So this is the start of the year. And you could see this is a 50% growth from the start of the year, including the tariff dip. So it's had a magnificent rally off the April lows and trading at these highs right here. These are the all-time highs. So it does have quite a bit of work to get to that 162 level, but it does look like, based on our fair value metric, which we peg fair value at $160 per share, the all-time highs is where the stock would be fairly valued. So I think Micron is a buy right now. It's above its 200-day moving average. If we do get pullbacks in this name, I would probably buy, right here at this level, probably at the $120, $118 level. It's also where there's this huge volume shelf. You could see there was plenty of consolidation right here before the tariff tantrum, and then we ripped up to the upside. So I would say go ahead, add some Micron to your portfolio. These earnings should support the stock. Probably go ahead and take out those all-time highs by the end of the quarter. I wouldn't be surprised if we do see that. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.